Investors seeking high payouts often bet on covered call funds, only to find out later that in some of these investments, the fund company is simply giving you back your money rather than creating a return. Many funds are not really diversifying investor portfolios either, as they are writing calls against the same indexes like the Nasdaq and S&P 500 that most savers already have sizable positions in. A high yield alternative that will also diversify your portfolio can be found in the arena of high yield credit, where corporate bonds and loans, often packaged in closed end fund wrappers, can provide returns greater than 10%. So hit that subscribe button and join me today as I review 6 high yield funds and which one I'm investing in for my own portfolio right here in the red zone. In my last episode on high yield funds, I went through some of the risks and characteristics of high yield investing. As I looked to make my own investment, I came up with these initial screening criteria and selected 6 funds to review. One of the things that I'm super sensitive to because I lived through it is how these funds performed in the great financial crisis. And so I'm not looking at funds with inception dates in 2008 or later in this space, as in my opinion, they haven't really been tested. So, without any further delay, let's get into these funds and see which opportunities we like the most. Our predominantly US funds are ticker symbols GOF from Guggenheim, HYT from BlackRock, MCI from Barings, and PCN from PIMCO, while EMD from Western Asset and TEI from Franklin Templeton are both emerging market high yield funds. The first indicator we're going to look at is total return since 2007. For our US funds from November of 2007 until present, PCN wins with over a 500% return, followed by GOF in close second, MCI with over a 460% return in third, and finally HYT having a total return of 318%. For the last 10 years, GOF is the highest returner with 180%, while HYT trails the pack with only 131%. In the last 5 years, MCI was far and away the place to be with over 114% total return, while the next 3 funds trailed significantly with only around 25%. Over the past 3 years, that same story really played out, although PCN looks a little bit better here than it did at a 38% total return. In the last year, we see PCN taking the lead, followed by MCI with the other 2 funds having a negative total return. In the past year, all have had a negative price return, which can be primarily attributed to headlines and general fear in the junk credit arena, with some higher profile bankruptcies. HYT's negative total return can also be attributed to a recent rights offering. A rights offering, in simple terms, is a period of time where a closed end fund is issuing more shares and often not only depresses the fund's price, but introduces more short term price volatility. We'll see why GOF's price may be depressed a little bit later on. Looking at our emerging market funds of EMD and TEI over those same time horizons, we see EMD as our longer time horizon leader in any time period beyond 10 years, while TEI takes the lead from 5 years until present. So in round one, I like the historical and forward looking total return prospects of both MCI and PCN. And I didn't like HYT, and it's in the red here because it routinely underperformed its competition across all time periods. From an international perspective, I also like TEI over EMD, primarily because it's outperforming in the short term, while international and emerging market asset classes in general are all moving higher. Next, we're going to look at the consistency of the distribution payout as well as the current yield. If you see spiking bars on the charts as I show them, those are special distribution payouts when the fund decides to pay out more than its traditional schedule due to usually an earnings windfall. First up is GOF, which is the best of the bunch. No dividend cuts, raises along the way, and it's currently yielding over 17%, which looks good, but we may see later on that it's creating some problems. Next up is HYT, which cut its dividend prior to and after the great financial crisis, has made some other cuts along the way, but also some increases. But overall, not really a great story. MCI did not cut its dividend during the GFC like it did at the end of the .com decline, but did have to cut it in 2020, but then started to raise it again with some rising interest rates and was flat last year. Finally, for our primarily US asset closed end funds, we have PCN, which has never cut its dividend since the great financial crisis, nor has it raised it, but it has paid special dividends along the way, although none in the last 3 years. For our emerging market credit funds, EMD generally shows a downward trend throughout its history, although it increased its payout in 2025. TEI switched from a quarterly distribution policy to a monthly policy in the late 2010s and had a choppy ride until the early part of 2023, where it's been stable. It also paid out a massive special distribution at the end of 2025. Overall, here I like GOF and PCN, although we may have some current concerns with GOF's distribution. And from an emerging market perspective, I like TEI here, and history slightly better, but it could be more of my own recency bias of their recent stable dividend combined with that large December special distribution. Next, we'll look at leverage the fund uses, with less being better for me. PCN is the best, with just under 6% leveraged, followed by MCI at over 12%. GOF and TEI are in the teens, followed by HYT just over 20%, and EMD holding the largest leverage of the bunch at over 24%. One of the more critical screens for fixed income closed end funds is earnings coverage and how the fund is generating its distribution. Here's why I made the comment earlier that even though GOF's historical dividend looked great on that dividend chart, it could be at risk. Unlike other funds where return of capital is not necessarily bad, it is almost always bad in purely fixed income CEFs, as you only do that when the fund is not generating enough income to cover the distribution. GOF's earned coverage is only 33% and is making that up with return of capital, which could lead to NAV erosion long term. A lot of this fund's return over the last year is simply giving back your money, as far as I can tell. Now, GOF may decide to let this continue rather than cut its dividend, but either way, it's a bad sign for the fund at present. HYT's earned coverage looks better than GOF's, but is still relying on over 20% return of capital to pay its distribution. MCI is the chart we want to see for all of these funds, 100% earned coverage from the fund's income. PCN looks pretty good, although we'd really like to see an earned coverage above 90% and obviously as close to 100% as we can, like MCI's. EMD's doesn't really look good here, while TEI covered its monthly distributions, but also decided to pay that special distribution, which it looks like it sourced by selling some of its assets, creating short term gains, as well as returning some capital to investors. So for earned coverage, I really liked MCI and TEI, while PCN's wasn't terrible, but weaker than I'd like to see with the others showing signs of potential issues. Finally, we'll take a look at the fund's quality, which we'll do by looking at the credit ratings of their holdings. Starting with GOF, it holds mostly loans and corporate bonds, with the credit breakdown that is generally above a single B. HYT's holdings are far more weighted toward corporate bonds, with around 13% outside the US and only about 12% loans. Its credit quality is generally above a B, but it has a larger holding of triple C rated debt at around 15% of the fund's total portfolio. MCI is almost a pure loan fund, with CEF data not displaying its credit ratings, but Morningstar rates its overall credit quality at a single B. PCN appears to have the most assets in its portfolio that would be considered investment grade, with just over 20% triple B, 16% triple double A, and over 13% triple A. Loans comprise the largest part of its portfolio at over 26%, with around the same amount of US and international corporate bonds at just over 13% each, with an overall US portfolio exposure of 78%. EMD holds primarily foreign sovereign bonds, which helps its credit rating with countries from the Western Hemisphere, having the largest allocations, but as you can see from the color wheel, holds a lot of different geographies. TEI also holds primarily foreign sovereign bonds, with countries in the Middle East comprising the majority of its portfolio, followed by South America. CEFdata.com doesn't provide a credit rating for the overall portfolio here, but according to Morningstar, the overall credit rating is BB minus. In summary, GOF and EMD stand out with an overall credit rating of BB and BB plus respectively. PCN and TEI are next with a BB minus, and HYT and MCI trail with a single B overall credit rating. So now that we've looked at these funds and collected some data, let's see which ones are ones we like the best. I'm going to start out by eliminating GOF due to its earn coverage. Although there was a lot to like from its distribution consistency and total return, one of those will suffer if it doesn't turn around its earned coverage, and until it does, I'm going to sit on the sidelines for this one. I'm getting rid of HYT today because it generally performed the worst in all the categories we looked at. MCI looks really strong, especially on the shorter time horizons, but given its fluctuating distributions, higher leverage, and somewhat lower credit quality than PCN, I'm going to eliminate it as well from future consideration. From an international perspective, I'm also going to eliminate EMD due to its earn coverage as well as the fact that it uses slightly more leverage than TEI. So, with that, I'm calling a win for PCN and for international diversification, TEI. Now, just because these funds are the best for me, it doesn't mean that they're right for you. It also doesn't mean that it's a great time to start a position in either one of them. Closed end funds often trade at either a premium or a discount to their overall net asset value, and PCN is currently trading at a premium. But looking historically, it pretty much always has. And looking at the more recent past, its premium is lower than it's been historically. Unlike PCN, TEI has historically traded at a discount. And as we can see, is trading at one of the lower discounts over the past 5 years, which means you're getting less of a deal than you would have historically. Now, it's not necessarily a reason not to invest in TEI, especially if you believe that international markets and assets will continue to outperform like they did in 2025. But if you're not sold on that momentum narrative sustaining, then you can decide to wait for a better entry opportunity. So, which high yield fund is right for you? Feel free to leave a comment and let the community know. For other comparisons of funds yielding around 8%, check out this video where I compare different fund options from the energy sector. Until then, I'll see you next time right here in the red zone.